5 million IP addresses and 5 million cryptocurrency wallets are the starting points for the internet. The internet, which was the world's fastest ever adopter of new technologies, expanded at a rate of 76% per year until year 8, when it slowed to 43% per year. A year ago, crypto's growth rate was 137%. Currently, there are 516 million subscribers compared to 187 million on the internet. Then, we predicated that cryptocurrency will just experience a halt in its meteoric rise, matching that of the internet. Say, in my opinion, that will not transpire. To my mind, it will be quicker. But by the year 2025's close, we reach 1.1 billion subscribers. So that's twice as fast as the internet grew. A significant milestone was reached for the leading cryptocurrency when, at 9:34 p.m. on May 5th, the Bitcoin network conducted its 1 billionth transaction. Clark Moody, a website that tracks Bitcoin transactions, reported this accomplishment on social media. It happened exactly 15 years, 4 months, and 4 days after the first Bitcoin block was mined on January 3, 2009. In 2024, the Bitcoin business will reach yet another major milestone. According to renowned macro analyst and former Goldman Sachs CEO Raoul, he pointed out that crypto adoption is happening at twice the internet pace and is projected to reach approximately 1 billion users by the end of 2025, even if prices have just dropped. Binance data shows that 65% of crypto users hold Bitcoin, which is reinforced by similar projections made by independent Bitcoin expert Willy Woo, who claims the industry is on track to reach 1 billion users by the end of 2025. Reaching 1 billion users by 2030 is something that everyone agrees is going to happen soon. All digital assets should see a substantial boost in value due to this growth. Powell recently posted a video to his Real Vision platform in which he reaffirmed his bullish prediction for the future of cryptocurrency by discussing the influence of macroeconomic factors on the market. Therefore, to begin, we note that U.S. and global GDP growth rates have been trending downward for some time. There has been a recent pattern of GDP growth of around 1.75%. If it's falling, why? There are 3 main drivers of the trend rate of GDP, in case you forgot. First, the increase in the human population. Number 2, increased output. Thirdly, the increase in debt. Okay, now we'll talk about those 3 things. The first thing we should do is examine production. Has been falling steadily due to an aging workforce, which in turn reduces GDP's trend rate. Alternatively, debt has been increasing. Banks simply ceased lending to consumers in 2008, which meant that household debt growth ceased. Therefore, it is more difficult to accrue debt. In addition to corporates paying off debt, GDP growth has been slow. However, as is widely known, central banks are now the primary drivers of debt increase. At the moment, the United States is issuing more debt to cover its enormous deficits. But demographics are the most important factor here. They influence everything in the world, including the everything code, inflation, and return on assets. Thus, this is the trend rate of increase for the working age population, which includes those aged 15 to 64. Its decline has been steady. As people live longer, those folks don't get much done. Your productivity declines as you age. A debt that they had taken out in their younger years is now piling up. Now we understand a lot more. This is something I've covered extensively on Real Vision before. However, we can also look ahead. And this chart, the labor force participation rate, has been making appearances in my previous post on the retirement dilemma, as opposed to the infant mortality rate, which is ultimately just the birth rate plus or minus 14 years. Moreover, the number of persons actively seeking employment is directly related to the birth rate. Furthermore, it implies that the labor force participation rate should decline steadily over the years. We will also observe some uptick when part-time workers return to the workforce due to people's lack of financial resources. The labor force participation rate will decline in the long run, nevertheless, as fewer individuals are entering the labor market to replace those who leave. That is the issue that causes economies to slow down. As a result, it has spread from Japan to China, South Korea, Taiwan, and the majority of Europe. In any case, that is the major tendency, and this trend is unique. The U.S. government debt to GDP ratio is a perfect reflection of the labor force participation rate when all other factors are removed, and demographics is crucial. Thus, it follows that the government debt rises as the workforce shrinks and the economy slows down due to the high cost of providing services to the elderly. That chart is just mind-blowing, and the correlation is absolutely astounding. In order to comprehend the current state of affairs, the rationale for government's perpetual issuance of debt, and ultimately the necessity of printing money to address it, The population is the determining factor, therefore they inject more money into the system by taking on that debt. That's the monetary debasement I said earlier. Federal Reserve liquidity and the U.S. debt to GDP ratio are shown to be positively correlated. To put it simply, they are interchangeable. Although the scales are different, the general pattern remains unchanged. To fund the increase in debt, they are debasing the currency in order to increase liquidity. A term for it is financial repression. Another striking finding from the Everything Code, which serves as the actual mechanism, is that the majority of the increase in the national debt is merely attributable to interest payments on outstanding debt. Borrowing additional money to put into the economy is not what they're actually doing. Paying off previous loans is essentially what it is. Thus, the liquidity for this cycle is highly correlated with the interest payments from the prior cycle. That is, when the time comes to renew the debt, they issue fresh debt. This cycle has already begun with the issuance of fresh debt. Consequently, the government liquidity debasement program was used to cover the interest payments from the previous cycle. Thus, they are enhancing the system's liquidity. Give that curve a good look. That's the anticipated trajectory here, propelled by the interest payments on the massively increased debt caused by the pandemic. As you pile on more and more debt and interest payments, it's easy to see how this debt keeps growing. I don't think it will work out exactly like this, but moving forward, we may anticipate a significant rise of liquidity. And that is fundamental to the idea. So you get the picture. Take a look at that. Overall liquidity trend. Consider it once more in an alternate reality. The debasement of currencies is a tendency that is still going strong. Debasing the currency creates the false impression that asset prices are going up. This chart displays the correlation between the Nasdaq and the overall liquidity index. Actually, the correlation is 97.5%. Due to the fact that this is a secular tendency, the Nasdaq has actually done better. However, though, because of this debasement, the correlation between all assets throughout time can be explained. This is the most important chart to comprehend, though some things do lead and some things lag. Increased debt is the demographic response. This economy is moving at a snail's pace due to demography. They debase the currency and issue more liquidity to cover the costs in order to get over that. Asset prices go up because of that. This code is crucial and covers everything. All of the world's main central banks have contributed to this global liquidity index. Its yearly growth rate is 8%. Now, when you include an inflation on a worldwide scale, let's say it's 4%, you get a hurdle rate of 12% for any investment. Now that's mind-boggling since the S&P 500 only goes up roughly 12% annually, therefore performing it will not help you advance. Investing on the now rather than future worth is how you can save money. For those who aren't familiar with it, this 12% barrier rate presents a significant challenge. If you don't reach your 12%, you will essentially be worse off financially. Therefore, your future self